everyone, welcome to Officer 24/7. My name is Niharika Walia Bhatnagar, and today I'm with you with another topic of ABFM. But what am I starting with today? I am starting with another topic that is now I'm starting with another module as well, if I have to tell you. The series is going on, module A all sorted, module B all sorted, and today I'm starting with the module C right now. So before I start with the module C, just a request, please like the session, share it among your peers. Along with this, since we have started with the module C, save the PDFs as well. The PDFs are really helpful for you. Okay. For that, what you can do is the links are given just below the particular class itself. You can download it from there itself. Acha. Module C. Module C is basically an extension of Module B, to be very honest. Matlab, if you have done the Module B properly, it has nothing to do with A. A was pure theory. B is something which is based upon practical plus theory, more of practical side, less of theory side. And then we have Module C, which is balanced, which has both theory and practical side. In the examination, more or less, you will find more or less bankers have always told me, ma'am, in the examination, we get lesser of numerical portion and more of theoretical. Why do we do so much of numerical part? Why do you make us do all that? In the examination, if you just go through it, now you'll be surprised to know that in the exam, they are covering more numerical portion than the theoretical area. In what way? The numericals are not given. Module A and Module D. Nothing theory, nothing practical, pure theory chapters. So there you get saved. In Module D, there is a little part black shoals. Only the black shoals is basically one of the only thing that I've seen in terms of the practical part, but it is too much practical. So I believe that particular part can be asked in the numerical portion only. Sorry, theoretical portion only, not the numerical portion. Then we have module B and C. In the module B and C, module B has more practical side than the theoretical side. C has both the balance. Now, what happens is now they have started asking questions which are based upon assumptions of the formulas. Imagine if you don't know about the formula, how will you look at the assumptions of it? They will ask one part of the formula as a question, that this particular item of the formula, what does it mean? Or what is the thing that you will find in terms of utilizing this formula. Matlab, in the entire question, you will be surprised to know that what they are giving you in the examination is more or less troublesome rather than, I would say, which is more um, easier. Why? Because if you are doing the things properly, then ABFM is a piece of cake for you, a smooth sailing. But if you are not able to do those things properly, then there's a problem. You know. So keeping in mind the entire scenario, we are starting with corporate valuation. What do you mean by corporate valuation, everyone? Every company which is working in the world right now, especially when we talk about our country, they have to keep improving themselves. Why on earth I would put money into an organization which is not showing its performance? Will you go to someone who's not good at his work? No. We go to only that person who's good at work. So why would I put my money into a company which is not earning good money? If they are, then I'll go to that. If they don't, then I won't. Then that is corporate valuation. In the corporate valuation, uh, we can take it up on the basis of book value, on the basis of market value. Rather, in terms of corporate valuation, there are multiple ways of valuing. There are multiple methods. Keeping in mind all those various methods, we are starting with the module C. Now let's understand what is the book value in context of corporate valuation. The value derived from the market analysis, the value of assets or entity based on financials, the market capitalization of the company or number of outstanding shares multiplied by the share price. Book value. Acha, book value is in terms of corporate valuation. Book value should be the value uh, at which we actually bought those particular uh, assets of the company. If I talk about the assets, if I talk about the organization point of view, this is the actual net worth in terms of the books, not the market. So market capitalization is something which we cannot take up. So either it can be the value of the asset or the entity based on the financials or number of outstanding shares multiplied by the share price. In this case, the correct answer is the value of an asset or entity based on the financials. What will you do? You will write the name of the value of that asset. Say the asset is worth rupees 20 lakhs. From that, you remove the depreciation out of it. So depreciation would be removed and whatever is left is considered here. So this is the particular portion which is called book value. Every single year, we will keep on calculating the book value, everyone. Okay? That is what we'll be looking forward to. Next question. Anji, so let's continue further. What does enterprise value represent in corporate valuation? The book value of a company, market capitalization, the value of running assets, including debts and other commitments, and total equity of value of the company. Acha, everyone. Now, the next troublesome point is what does enterprise value represent? Matlab, corporate valuation is what I told you. This talks about the book value. What is this particular thing called EV? Hai na? This is again a troublesome thing. Let's talk about EV as well. The book value of the company, or the market capitalization of the company, then the running assets, including debts and other commitments, or total equity. Enterprise value is the value of the entire organization. It's not based upon only the assets of the organization. This is based upon, again, assets, debts, as well as other commitments. Matlab, this is, if I tell you, if I ask you, what is the value of your organization? You will not say, ki, my shareholding was this much, then this is the money that we have borrowed. No, we will outrightly say, देखिए, the value of the organization is 100 lakhs. My part is maybe 80 lakhs, and then 20 lakhs is something that I have borrowed. So technically, when I'm trying to find this, this is a part of capital and this is a part of the borrowings that we have made. You know, that's the entire scenario regarding the work. Acha, what is the fundamental goal of management in relation to the corporate valuation? Maximizing the book value, minimizing the enterprise value, maximizing shareholder value, or minimizing the market capitalization. What is it? Everyone, basic pyara sa question. When we're looking forward to it. Corporate valuation, I find, is okay. I won't say this is a very easy chapter for any non-financial person. Rather, for anybody who's a non-financial person, these kind of chapters are genuinely very frustrating. Why? Because these are typical finance terms. Matlab, even if I want to know, I cannot understand these topics that easily. That's very true about these. Ji, according to you, what would be the correct answer, everyone? uh, what is the fundamental goal of management in relation to corporate valuation? Rule number one, we always look forward to maximize the shareholder value. And there are two things that we maximize, everyone. In this is where, if you talk about the financial management as a big chapter now, big part of the accounting area, we say maximizing shareholder value and maximizing profits. Two things. These two things are something which every organization aims for. They want to increase their business portion and they want to increase their shareholder value. Technically, if you earn more profits, you will pay more and you should pay more. Otherwise, shareholders will run away. You know? So you earn more, you pay more, and both of you are happy. Company is making good money, it will expand. Shareholders are happy, they're getting dividend, and they will expand too. They will also put more and more money into the business. They are ready to do that. They are ready to keep more reserves and surplus of the company even. You know? But yeah, no, this is what every organization will look forward to. Both of you are growing further. Positivity. Maximizing the shareholder value. Then Why is valuation considered as utmost relevance in today's business world? To complicate financial data? Definitely not the point. This is a true point that we can eliminate. Irrelevant for the managers, I can see this is also not the point. Only for regulatory compliance or due to economic liberalization. Acha everyone, the actual point is due to economic liberalization. As such, majburi bhi hai. Every company has to follow this because law says it. True fact, company law states it. First is company law, and as if company law was not enough, income tax department also asked them to prepare the books of accounts. GST department also asked them to prepare the books of accounts regarding provident fund, and I think banks and other organizations have to report to RBI as well. Then SEBI also asked for their books of accounts. So they prepare their books of accounts as per this and this, and all these regulatory bodies of the government are after their life if they don't provide the books of accounts. In a PF, for PF, you have to provide the information of your employees, what are the salaries. Now, this is the same information. Income tax department is also going to see, ki hanji, you show this much of amount of salary. Are these people getting the salary? Company law also says something. So this is all a very interesting cobweb. If all the, abhi to, there has been a process where they are centralizing all the coordination between all the different departments. That means one department can check what is the information given to another department. So company law can check IT department's books of accounts given by the person. Matlab he cannot give two different books of accounts to two different areas until or unless law requires to do them. That means they have to prepare it in a certain format. Otherwise, it's all the same. Excuse me. Okay. How does the United States Internal Revenue Services define fair market value? The price at which the property would change hands under compulsion, the price at which property would change hands between willing buyer and willing seller, the maximum price a buyer is willing to pay, the minimum price a seller is willing to accept. IRS, Internal Revenue Services. What are they talking about it? But I think the value of the thing should not be based upon if I'm a seller, I would always try to sell at a maximum price. And if I'm a buyer, I'll always try to buy it at lowest price. You know, you said that this the value of this thing is 10 lakh. And I am a seller. And while you are a buyer, you will say, nahi, nahi, this is hardly of 4 lakhs. Now what's the actual price? They say, let's talk to each other. Seller said, nahi, nahi, I think 8 lakhs is minimum, sir. Beyond that, I cannot give. This person comes to 6 lakhs. And then ultimately, he also agrees to pay 8 lakhs. Now, 8 lakhs becomes the fair value. We cannot take one sided points there. It cannot be one sided portion. That means the price of the property, which is a compulsion, which is basically willing between both the buyer and the seller. They have to find a balance now. Fair value would always be based upon that because everybody has their own point of view. Seller will always pray ki Bhagwan, I get more price, and the buyer will always be like Bhagwan, I want to pay less. Now the point is, God listens to both of them and they come to a point कि ठीक है ना, this is where you don't lose, I don't lose, we get a win-win situation, and this becomes the fair price in the market today. Hanji, next question is which committee of is responsible for developing the international valuation standards? IMF, International Monetary Fund, International Asset Valuation Standards Committee, International Revenue Services, or International Accounting Standards Board. All these are very reputed organizations responsible for the accounting that we do today. But we are talking about, I hope it is visible now. I hope it is better now, everyone. Which committee is responsible for developing the international valuation standards? International Monetary Fund, International Assets Valuation Standards Committee, then International Revenue Services, and International Accounting Standard Board. The answer is B. The answer is B, everyone. International Asset Valuation Standard Committee is responsible for this. IABS Committee. Acha. Everyone, next point. What is the inherent premise of the cost approach? Premise is assumption. The value is based on market trends. The worth of the firm is evaluated based on cost to rebuild and replace the business. The value is determined by recent transactions, or the worth of the business depends on the intangible value. Inherent premise. Inherent means inbuilt, and premise is assumption. What is the inbuilt assumption of cost approach? Cost approach matlab at what price we are buying things. Energy. So if we're talking about the cost approach, everyone, what would be the price? Everyone, in terms of costing, na, there are two ways. You either record it at the price that you paid while purchasing that particular thing, or the second can be the replacement price. If I replace it with something else today, at what price I can replace it? The value is based upon market trends. No, the worth of the firm can evaluate based on cost of rebuild and replace. That's the answer that we'll take. Either we have the particular actual price that we paid for, and it can be B. The worth of the firm can be evaluated based on cost to rebuild or replace the first business. Which is not one of the four primary methods for determining the value of the firm? Adjusted book value, stock and debt, replacement cost approach, and discounted cash flow approach. Four primary methods. There are actually, which one is not the one of the four primary methods? Adjusted book value is there. Adjusted book value, you actually adjust that book value portion there. Okay. Then second method is also there. Stock and data approach is a very important method. You'll see a lot of topics, not only this particular chapter. I think one chapter more down the line. Then you will also, in the non-discounted models, I believe, you will see the stock and data approach again being discussed about. Then discounted cash flow approach is an approach which you have just seen in capital investing decisions, and this is something that is going to continue in the entire working, everyone. This particular topic doesn't leave us. This particular topic is super important. So in this case, the next important point that arises is replacement cost approach is not the one. This is not there is no such approach called replacement cost approach. Okay. Either it is discounted and non-discounted cash models are also existing, in which one of the favorite ones that has been asked in the examination as well is direct comparison. Matlab, if you and I are in the same field, if you and I are doing the same work, if you and I are doing everything similar, then I can note down my value as same as yours with the little tweaks for sure, because none of the businesses are exactly the same. They would vary a little different, you know. How is the value of the cash and cash equivalents determined? Historical cost, market trends, their face value, or by their market value. How is the value of the cash and cash equivalents? Cash and cash equivalents is based upon what? Everyone, if I have cash, there is no not there is no market value. If I have 100 rupees in my pocket, it will remain 100 rupees no matter what. If I have the bank value in the bank, the values remain the same. So there is no market trends. There is no market value. Rupee remains rupee. The worth of one note can vary, but it is still 100 rupees. You know, by historical cost, not really. When we talk about the cash and cash equivalents, I cannot record the price which was the cash which was existing in maybe 1990s or 2000. I think at one point of time there was a 20 paise coin which was there. Right now it's not there anymore. So what do you mean? Historical costs are not recorded. But this is just an example that coins are replaced. So obviously in terms of money, if you are talking about the past money, then it won't be of any value. You have to write it at face value. What do you see on the note? You see Mahatma Gandhiji and then you see 100 rupees. That's a denomination. And that is how we record cash and cash equivalents. In the bank, if I have 100 rupees, there is no question asked. There is no points raised. Ki maybe the market value of the bank would vary. No, either I'll get interest or either bank will charge bank charges. Nothing else is gonna happen. You know? What is one of the most essential aspects of organizational capital? It can be readily disassociated from the company. It depends on the market trends. It is connected to the company as a functioning entity, or it is impacted by historical cost. Organizational capital मतलब पता है every organization is always impacted. They have to prove a lot themselves कि अरे नहीं, we are earning good money. They have to keep on proving themselves, है ना? So this particular base is super important to them. What do they do here? It is basically connected to the functioning of the entity. ठीक है? Is connected to the company as a functioning entity. Organizational capital is a reason there the organizations are surviving. So this would be the answer. Acha, one more question to go and then we'll be done with the class. How does inflation impact the book value of the asset? Okay, let me give an example. The okay, let's take a particular place called A, State A. Okay, in 1980s, you go to any part of India, people could buy two marla house, one canal house, four marla house, six marla house. There is no, in our area we have this particular point of marlas to measure it. So normally people used to buy six marla house, which was decent, then eight marla, then 10 marla, and further. People could buy. This is what I've heard from my grandfather, that they bought the particular place where we live in. It was in Madlas for sure. Then we talk about that particular place. He bought it for maybe around 20,000 rupees. The particular place which he owned. Surprisingly, over the period of time in maybe 1980s, if you buy something, the price of all those plots and places, not only my grandfather, I think this is something I've seen in many other people. It won't be 20,000 anymore, isn't it? During COVID, people had seen a drop in terms of property prices. But if you buy something for 20,000 and in 1980s, places right now, minimum, if you were having a good place in commercial areas and specifically areas which are right now in the developed regions, the place would be between 2 to 3 crores minimum, depending upon the area and of course the population and overall development in that area. That means over the period of time, the value has increased. That's because of inflation. Inflation has no impact on book value. It has an impact. It increases the book value, it decreases, or it doesn't affect the relationship. Now, the point is the answer is it decreases the book value. Acha, this was related to the property, but when we talk about inflation in terms of other assets, what happens to it, everyone? Um, Maybe I bought a phone. Normally, an iPhone costs you, if it's new, then 80 to 1 lakh 20, right? As soon as the what was the price that people used to pay earlier when they started buying this phone? I'd seen people buying in black, maybe for 60, 65,000, the gold ones, the top ones. So that means earlier, they were available between 50 to 60, I think probably in 2012 onwards. Right now, the same phone goes up to almost double of it. What is it? The book value of the things overall gets impacted because of inflation. The value of it is going up, but due to inflation, the value of money is going down. So, in context with going down of the value of the money, we call it decreases the book value. Hello. Okay. Hello everyone. Welcome to Offset 24/7. My name is Niharika Valia Bhatnagar and I am with you with the area of AFM. I hope I'm clearly audible as well as clearly visible, everyone. Okay. So, what are we going to do today? Achha, I'm sorry. Just a moment. Okay. Good morning, everyone. Actually, it's now afternoon. We normally meet in the morning at around 7 a.m. for this particular class, but today we are meeting in the afternoon. So, good afternoon and welcome to Officer 24/7. My name is Niharika Patnakar and I am with you with the area of ABFM. Today we are talking about CIIB ABFM Module C. I think the series started a few couple of weeks back, done with the entire module A, done with the entire module B, and currently pursuing the module C. First of all, if you had been reviewing these specific classes, then please go ahead and like these particular sessions. Your responses are very important to me because ultimately this is a source of motivation because someone is getting any kind of benefit out of these classes. It's one of the first things where the hard work that we are putting in is getting materialized. So that's the basic thing that I think we should look forward to when it comes to our classes, right? Then, till now, we are done with entire module A, entire module B. And in the module C, we had started with the area of discounted cash flow valuation. Cash flow valuation, discounted means we are talking about the present value, everyone. We cannot rely on, if I said that I'll receive 10,000 rupees in the second year, in the third year, in the fourth year, the value of the money is changing every single year. So obviously there is a variation and I have to consider that variation. And if I'm not considering that, the time value of money would mean that the 10,000 that I'll receive 2 years later is going to be the same, then my ideology is wrong. I have to consider the fact that yes, over the period of time, the value of money would decline, and at that point of time, and if I receive 10,000 today, there is a difference between the two. That's what we talk about discounted cash flow valuation, everyone. In terms of discounted cash flow valuation, what do we talk about? Acha, give me a moment. I think this question would require this. Acha, everyone, when making valuations, the market based approaches should not be used. Market based approach means what is the value of the organization in the market itself. है ना? So, what will we talk about this, everyone? When the size of the company is insufficient, or when company's assets are lower than its liabilities, in the event there are significant and unprecedented shifts in the market price, or when it is challenging to provide an accurate estimation of the realizable value in the event of a going concern. When we talk about the market based approaches, I believe if the market is changing very frequently, how will we rely on it, everyone? In the event there are significant and unprecedented shift in the market price. The market price is changing so frequently that if I rely on this market price, then we would get more or less stuck in that particular area. How will we work at that point of time, everyone? Won't it be too confusing? Won't it be something that we'll feel this is unpredictable about? Matlab, I personally feel that if the market is changing so much, then even if we want to find a trend, we just can't find a trend. If we cannot find a trend, we should not rely on that particular portion, don't we? So, in this case, when we talk about the market price, it should be in a situation where the organization is having a stability and they can see what is going on in the market with themselves as well, because you can control your organizational environment. But what about the market? When COVID was hit, entire world was hit. The markets were hit. When any war happens, if, for example, the Israel-Palestine war, and when we talk about the Russia-Ukraine war, the entire country's market prices had been under a major uncertainty. You cannot find a specific fashion or trend in terms of the movement of the prices. They are just moving here and there as per the requirement. The demand goes high, the price goes higher, right? That is the particular scenario. So then this is not reliable when you see a lot of speculations around. The discounted cash flow method of valuation is based on the discount for the future that is anticipated and is likely to be earned. The company's valuation or anticipated cash flow along with discount rates or the company's potential for earnings. Everyone, The discounted cash flow valuation is based upon what? I told you, when we talk about the discounted cash flow valuation, we are worried about only and only one thing. What is it, everyone? We'll be worried only and only about one thing. That is whether the books of accounts are prepared in such a way where we are looking at the values not from the present point of view, but we are looking at the things from the point of view of future. ठीक है ना? We are looking at it that what would be the value in the future and how do we look at it, right? So in this case, what's going to be the answer, everyone? A discount for the future is that is anticipated and is likely to be earned. The company's valuation or anticipated cash flows along with discount rates or company's potential for earnings. You cannot find out the potential for earnings, but yes, you can anticipate the cash flows along with the discount rates. Matlab, you know that you are going to have 1000 rupees minimum in the upcoming year, then it will grow further. Once this business starts growing, then it can become 5000, then this can also become 4000 in the upcoming future, and you find the discounting rates here, and then you multiply and find the discounted value. This is the method in which they are using the discounted cash flows. Under the discounted cash flow valuation, which of the following is typically employed as a discounting factor, everyone? Cost of equity, then cost of debt, annuity factor, or overall cost of capital. What's going to be the answer? Under the discounted cash flow valuation. Everyone? Under the cash flow valuation, what is it that will be coming there? Chali, then let's talk about the answer as well. The answer is overall cost of capital. You just cannot take only equity, only debt, or only preference share. Won't it be wrong? Reason? Think about it. If I consider only equity, only debt, or only preference share, their cost, the cost that we have to incur to maintain these people, है ना? Then what will happen? We have a blend of these three. In many organizations, you will find equity and debt. In many organizations, you will find all the three. That is equity, debt, and preference shares, because many organizations have started getting the preference share for their organization as well. So technically, when we have these, why don't we use the overall cost of capital? This is nothing but WACC. In WACC, you take the weight of equity into the cost of equity. You take the weight of debt into the cost of debt. Then last one is when you have to add, this is weight of preference share into the cost of preference share. So this is based upon the weighted average cost of capital of the entire process. This is what is considered, everyone. PV indicates the value in use, the value of the cash flows expected in the future, or the value computed using the internal rate of return, or the present value which a buyer is willing to part with. Present value is basically the value that would be today. है ना? In this case, the answer would be the value of the cash flows expected in future. ठीक है ना? We are looking forward towards the value in future. Because पता है basically how do we find the present values? We find it this way. Let's use the compounding formula. In compounding formula, how do you find your amount? Amount is equal to principal 1 plus r raised to power n. Now they are giving you the amount that you are receiving in the future, maybe after 2 years, 3 years down the line. So we will take this amount and we will divide it by 1 plus r raised to power n. This particular portion will go, this was multiplied here, it would be divided there, and there it is p. So the present value can be found out if we eliminate the interest portion from the amount. है ना? That is what we will choose. What is the basic thumb rule for determining what constitutes a moderate growth rate. Within 2 to 5% of the growth rate of the economy, within 5 to 8% of the growth rate of the economy, within 8 to 10% of the growth rate of the economy, or greater than 10% of the growth rate of economy. Moderate growth rate, everyone. For example, if we talk about India, what's happening here? Moderate growth rate. Moderate is not very high, not very low, correct? In this case, the correct answer is going to be within 8 to 10%. Okay? It is between 8 to 10% of the growth rate in the economy is moderate. Done? Then, oh, the answer is visible. Just a moment. What are the three main approaches for estimating the growth patterns when valuing a company, everyone? What are the three main growth rates? Stable growth, speculative. Speculative is basically which goes up and down at any point of time with the change of pricing. Then declining growth, it goes down. Then consistent high growth, low, moderate growth, and declining growth. Then stable growth, two-stage growth, and three-stage growth. Then is organic growth, inorganic, and hybrid growth. Since you have seen the answer, what would it be? The answer would be C. Growth rate, two-stage rate growth, as well as three-stage growth. The growth factors and the particular topics, when we talk about the growth, there are certain methods through which you can actually find it out. Okay? They use different models in this area. And consider discounting rates. That means they are considering the portion of present values here. Now done. Which particular organization, what characterizes company with stable growth, everyone? Earnings and revenue both significantly growth significantly faster than the in economy. Then is earnings and revenue growth equal to or lower than the nominal growth rate of the economy. Then is earnings and revenue growth slightly faster than the economy's nominal growth rate. And the last one is inconsistent growth patterns. What would be the answer, everyone, in this case? When we talk about the company with a growth rate which is stable, the answer would be B. The earnings and growth rate which are equal or lower than nominal growth rate of the economy. Okay? The answer is B, everyone. Why do high growth rate exhibit in terms of earnings and sales? They have nothing to show off. Till the time these organizations are growing further, na, they will always talk about the money they have received. How do they tell it? Because they are showing their books of accounts and they are showing their sales. This is enough for showing that the company is a huge growth company, right? Expansion at the rate equal to the nominal growth rate of the economy. Expansion at the rate slightly faster than the economy's growth, or examination at a rate significantly than the nominal growth rate of the economy. And the last one is the stable growth patterns. What is it when we talk about the growth rate, which is high growth rate companies? And what do? They normally expand and work a little faster than the others. Why? Because they are fast paced moving companies. Done, everyone? Here comes the next question. Which growth pattern is suitable for business growth at a stable rate? As I told you, there are different models. So according to you, go ahead and choose the specific model, everyone. Two-stage discounting cash flow model, three-stage, and the last one is the steady growth rate model. Acha, theek hai. Let's talk about which growth rate is weighted to the rate of stable rate in the two-stage discount cash model, or three-staged discounted cash flow model, or Then is steady growth, steady state models assuming a constant growth pattern. What would be the answer accordingly? The answer in this case would be steady growth model. You're assuming constant growth. Even in the book, they have given assumptions regarding the same as well. The assumptions should be read by you because they can ask you questions based upon this area. Done, everyone? Let's move on to the next question. What are the three criterias of the uh, straightforward application of the discounted cash flow approach or discounted cash flow method? In this case, positive present cash flows, and then we talk about accurate forest of future cash flows and steady risk profile. I'm sorry. Then we have the present positive cash flows and accurate forecast of future cash flows and steady risk profile. Then is negative present cash flows, unpredictable future cash flows and fluctuating profile. Then we have positive present cash flows, conservative forecast of the future, and dynamic risk profile. And last is negative cash flows, accurate forecast of the future, as well as steady risk profile. In this case, when we talk about straightforward application, they apply it when organization is all positive, they have accuracy, and they have a steady risk profile. If the risk is too high or things are so unpredictable, can you rely on the model? Matlab, personally, I would say, how will I rely upon the model when it is not giving me any conclusive result? You know, that's one of the basic things that we are always scared of, isn't it? The correct answer is A. Positive cash flows, accurate forecast of the future. Next point. What's the next point, everyone? The next point is, oh, the answer is also visible. What are the some of the models in addition to enterprise and equity DCF model that can be used for valuation? Dividend discount model and economic profit model, inflation adjusted and discounted, as well as we are talking about residual earnings as well as maintainable profit, or market share model or discounted profit model. Equity is always the residual earnings. They are the scavengers of the organization. They hunt upon what is left in the organization and then they maintain. But for this, whatever is happening, if there's execute losses, then they face a lot of problems. This is basically done in order to maintain the profits. So that is, it is basically the residual owners as well as maintainable profit model. The answer is C, everyone. Okay. What is one of the earliest discounted cash flow models that is considered as dividends? Consider dividends, everyone. Adjusted present value model, economic profit model, residual earnings model, and maintainable profits model. Which one of the following is the earliest one? The oldest one. What would it be, everyone? The oldest one is adjusted PV model. This is still used. ऐसा नहीं है this has been out of use at all. This is still in use.
Good morning, everyone. Welcome to Officer 24/7. My name is Niharika Walia Patnagar, and I'm with you with the area of ABFM. And we were doing the module C. And in the module C, we had started with the topic of discounted cash flow valuation. Discounted cash flow valuation is a specific method under which we find the time value of money of cash flows. है ना? That is required. If we don't do that, how will we actually find out whether the money that we are using would be helpful for us or not? The context of using time value of money is that we have future cash flows, we do not have present, and then from the future cash flows we have to find the value as per today, right? If we have to find the future value as per today, then obviously we cannot find the futuristic value without adjusting it, and that is what the discounted cash flow valuation talks about. What is the primary source of cash flows for equity investors in public traded companies? Interest payments, dividends, principal payments, or preferred dividends? What would be the answer, everyone? First question. Primary source of cash inflows. Sorry. Is it interest payments, dividends, principal payments, or preference dividends? When we talk about equity now, equity gets dividend. So in this case, the correct answer is dividends. Acha everyone, if you like this particular series, then please like it and share it among your peers as well, because I think this is a source of motivation for any faculty who's working at on these entire series. We are covering the entire syllabus. If you have seen, the module A is complete, module B is also complete, and currently we have just started with module C, and we are on the second chapter of the module C. And first of all, the most important thing I should say is save the particular playlist of the entire series, so that you would remember that the entire modules are covered chapter wise in this series, right? So on the last day, you can just look at all these questions quickly, or just a day before the 2-3 days before the examination, you can revise this portion, right? Now look at this question. The financial models that use dividends are known as FCFE discount model, FCFF model, dividend discount model, or cash flows to equity model. Dividends are given to the equity, so technically this is dividend discount models. What is the portion of dividend that people are going to receive over the period of time? Because these people receive the dividends, na? Equity shareholders share in the business is always dividend. There is nothing else that helps them, isn't it? Okay, the financial models that use dividends of cash flows. Oh, we are just done with this question. Dividend discount models is the answer, है ना? अच्छा, next question है. What does FCFE stand for in finance? Free cash flow to equity, financial cash flows to equity, firm cash flows to equity, or future cash flows to equity? When we talk about FCFE, this is free cash flow to equity. मतलब after making the payments to all the others, मतलब debenture holders has to be paid, preference shareholders has to be paid. When all these people are paid up, then whatever is left is kept for equity. ठीक है, then it is called FCFE. And when we talk about FCFE, we are looking at it over a period of years, and then we will measure the same point, NPV, find the net present value. Once you find the net present value, you can find out whether it is helpful for this organization or not. If it is positive, then accept. If it is negative, then reject. Next, how is free cash flow to the firm calculated? Subtracting interest and preferred dividend from net income, adding FCFE and cash flows to the lenders, subtracting net investment required for growth from after tax operating income, and subtracting dividends from net income. How is FEFE to the firm, everyone? FC, acha, this is FCFF. Oh, this is free cash flow of the firm. This is the money that the entire organization is making, not to the equity only. Na? In this case, they are considering the entire organization. So in this case, what do? Preferred interest and dividends are not removed. So this is wrong. Adding FCFE and cash flows to the lenders, no, this is after the payment to the lenders. Subtracting net investment required for growth from after tax, acha, this is true. You will keep a part of it for reserves and surplus, you know, whatever you want to keep. In our book it is written as internal accrual. The answer is subtracting the net investments required for the growth from the after tax operating income. Operating income is the income that the business is making. है ना? So this is operating income. Next point, why might the cost of debt be lower after tax are taken into account? Simple reason, everyone. You take a debt. You start making your project for which you have taken the debt. This will increase your income. You will still just have to pay the fixed rate of interest. He cannot say that, Arre, you have started making so much of money because of me. Give me more money. He just cannot say that. You know? Now, I take a debt. The project started. I made good income. And from this income, there is no role of equity here. But the company has started making a lot of income. And this is where equity is going to expect that where is my increased share. Because now the company is growing. If the company is growing, I have the right to receive the money in future. So if I have the right to receive the money in future, I should be given that preference. Interest expense are deductible from tax income. है ना? Then dividends are deductible from tax income. Debt is not subject to taxation. It is subject to taxation. This is obviously wrong. Principal payments are deductible from the taxable income. No, this is not the point. But the interest is allowed. In this case, what happens is, first of all, we just have to pay the interest. And that too, we can cry in front of income tax department, hi, this is an expense. You pay good amount of dividend to equity. Then even equity is indifferent. This is still not an expense. So isn't it better that we take debt where we get the benefit of interest and expense and we don't have to pay more if the income goes higher? Right? So the answer here is interest expense are deductible from the taxable income. If the income increases, the debenture holders will never cry about it.
that we need more money. They just know that other than the loan, they have no other right. But the exceptional case is equity. Equity is going to come after our lives, that they need their money. है ना? Equity shareholder will not leave the organization. How is diversifiable or market risk used in estimating discount rates for investments? It is ignored in discount rate calculations. It is used to estimate the risk premium. It is used to calculate the cost of equity. It is considered in determining the cost of borrowing. What would be the answer, everyone? It is a non-diversifiable or market risk. If it is a market risk, the market risk is something where you get risk premium on it as well. For this, they use the CAPM model, capital asset pricing model. Then, under this model, you receive a risk-free rate of return. This is the minimum that you're going to receive, plus your sensitivity analysis. This is beta, your multiplier, and then we have your market rate. You remove the risk-free rate. This is risk premium. This portion is called risk premium. It is used to estimate the risk premium. How is the cost of equity calculated according to the models which have been discussed? Okay. By considering only the risk-free rate, by adding a premium proportional to market risk to the risk-free rate, by subtracting the risk-free rate from the expected return, or by ignoring market risk in calculation. How can we find it, everyone? So we have just did that part. If you take risk, then you will add the premium. Acha, isn't this the same question? No, similar. This is actually similar. By adding a premium proportional to the market risk. Always remember, higher the risk, higher is the return expected. That is the only reason people put money into risky organizations, because they have expectations that they will soon be receiving more money. Otherwise, why would someone put money into something where it would be difficult for them to earn? What is fundamental concept of valuation that analysts should adhere to? Ignoring market values, indifference between purchasing and selling an asset at fair value, using book value weights, or ignoring default risk. What would be the answer? The fundamental concept of valuation. The fundamental concept of valuation is basically the price at which both the buyer and the seller are willing to purchase it. That is what we call the fair value. It means we are looking at both of them. We are not looking at from the point of view of the purchaser or looking at it from the point of view of the seller. We are looking from both the point of views, because one would want to buy, so he would like to pay the least price, and the one would like to sell, who would like to pay for the maximum price, isn't it? So that is indifference between purchasing and selling an asset at fair value. What is the challenge in estimating the expected growth in future cash flows?
Lack of historical data, uncertainty, predictability of past growth, or market volatility, everyone? What's the answer? What is the challenge in estimating the expected growth in future cash flows? Uncertainty. The problem is uncertainty, everyone. The problem is that the future is so uncertain that even if we want to, we cannot eliminate the portion of uncertainty. You know? So in this case, this is the problem of growth. Done? Next question. Why should the results of growth rate appraisals based on the company management or consensus estimates be questioned? Lack of expertise, inherent bias in the resources, high level of accuracy or transparency issues. What would be the answer? The problem is lack of expertise. Now you get experts. Consensus, basically, people have bias. I think if I don't like the particular person who has been dealing with it, I don't care whether he's right or wrong. I would just impose the fact that according to me, this should not be happening. This is the ideology now. People will impose their ideology, isn't it? This is inherent bias. This is called inherent bias in a resource or in the sources. So while taking decision making, it might turn out to be unfavorable for the organization because it's going to give you wrong results. What potential impact is mentioned regarding rent control to the anticipated growth rate of the cash flows in the real estate? Increase in value, no impact, decrease in value, or stability? The answer is decrease in value. Why? Let's look at it. When we talk about when we are trying to have a rent control, everyone, what will happen? If the uh, if the rent will grow further at a very higher pace, overall people will try to move away from that organization. This is one particular thing that you will always find. Higher the rent, people are feeling that, Arey, we cannot afford this particular place at all, isn't it? Okay, so that's it for the day, everyone. This is where I'm ending the session. But before I end my session, please go to our website and check out the courses that we have introduced. Go on to the area of Adda 24/7. Let me show you where to go. Just go on to the area of www.adda247.com. As soon as you reach the website, just go on to the area of JIB and CIB and open up the CIB June 2024. This is where you will find our Mahapacks as well as our Shapat batches and Nishchay batches. Along with this is our bilingual batches. And if you are looking forward towards our batches for the area of scholars, this is our English medium batch. What you need to do is that click on the area of buy now and use the code Y541. As soon as you use the code Y541, you will be able to get the maximum discount.
So just click on this, click on apply, you will get for 5519.77. So hurry up and check it out now.